there are some aspects of this inflationary pressure that ought to be transitory.
We'll stand ready to act one way or the other.
So the two that I would ought to be transitory are, one, related to commodity prices, including energy prices.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance, everyone. This is Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Meta's mega miss, while Facebook's parent plunges as user growth stalls for the first time ever. Nasdaq futures point to the downside. Policy split. The Bank of England is set to leave the ECB in the dust by lifting rates and signaling more to come. We're live in London and Frankfurt. And stay with Bloomberg Surveillance Early Edition this hour. We speak to the former Bank of England MPC member, Andrew Sentance. Send in your questions on IB Plus TV Go. He is always, well, shooting from a hip and always straight talking. Now, first thing is first, let's check on the markets. And the main question for the markets, if we focus our minds, is really how do you play this divergence between the Bank of England and the ECB? Then, if you're a dip buyer, or certainly you want to come in at some of these levels, what do the disappointing tech earnings in the U.S. mean for you? European stocks down some 0.3%, really dragged lower by technology shares, down some 1.2%. And of course, what we saw from Meta yesterday, formerly known as Facebook, but also some of the Spotify earnings that really overshadowed the good news we had from AMD is not only filtering through to Europe, but infecting some of the rest of the markets. Commodities still holding strong, but then instead of focusing on supply, one of the other things we need to hold on is demand. You can see Nasdaq futures on the way down some 1.9%. And when I have the best chart I need to show to you right at the top of the hour. We don't do this very often, but thank you, Valerie, for bringing it to my attention. And it's very clear that the market will try and push today. Andrew Bailey, again, we have the decision, we have a press conference, and then we'll try and catch a couple of minutes with him. We are seeing price in one of the most aggressive stances in terms of hawkishness from Andrew Bailey and from the Bank of England. We have not heard from MPC members that much in the last couple of weeks, so it really depends on whether he goes full-on Fed and is just as hawkish as what we heard from Jay Powell, or whether he tries to walk back some of that market expectation that we're seeing in the markets. You can see the Bloomberg forecasting some 1% by the first quarter of next year. So we'll have a full imprint of some of the central banks, and of course, you probably play it through currency divergence. Now, let's also talk about technology stocks. What are we witnessing, or have we witnessed peak Facebook? Well, that's the question, of course, at the top of investors' minds today after the social media giant's parent, Meta, reported that Facebook user growth stalled in the latest quarter. That and also a downbeat outlook saw shares plummet by almost a quarter in after-hours trade. Adding to that tech pain, Spotify announced a disappointing subscriber growth forecast for the first quarter. So let's dive into the tech story. Then we talk central banks. We're joined by our Bloomberg Markets editor, Christina Kino, and Alex Webb from Bloomberg Quick Take. Alex, I mean, Facebook is seeing some serious concerns, but then we knew also that users just were not using Facebook as they were in the past. How do they recoup the losses?
The problem was that it was a hit on several different fronts. The outlook wasn't good, the user growth stagnated, the revenue and profit missed estimates. It was sort of bad across the board. That is something that investors are therefore punishing them for. Meanwhile, you see TikTok continuing to grow. So it wasn't necessarily a story of lockdowns easing and therefore people not spending as much time on social media, because they are spending it with Facebook's rivals. So what do they need to do? They've said their North Star is to try to address the younger audiences, 18 to 24-year-olds. They've also investing in the metaverse. Can they do both? Can both of those be a success? It's not really. They did very well when they pivoted to mobile almost a decade ago, but other new product efforts on the whole have not been terribly successful.
And Christine, of course, this is, filtering through the broader market, because if you're a dip buyer and you kind of wonder whether some of the corporate earnings, can pull you away from the markets being worried about central banks, you kind of think twice because of some of the tech earnings.
Absolutely, Francine. I mean, for a moment there, it was looking like it would be a nice week to buy the dip and get back into some of those tech stocks, especially after some promising earnings from Apple and Alphabet. But then we got this shock from Facebook and Meta overnight, and that really just destroys this notion of there is room to buy the dip here, because, again, this asymmetric risk that we're seeing during the earnings season, there is outsized punishment awaiting any company, particularly any company in the tech sector that really misses on its estimates. And Meta here just missing massively. just getting the brunt of that pain from markets this morning.
Alex, when you look at how much Meta spends, and you reminded everyone, $10 billion on the metaverse last year, could this actually be a genius play? Like, what kind of timeline do we find out whether this was the right thing to do?
Well, there was some interesting comments from Mark Zuckerberg, because he was saying that the metaverse doesn't require 3D headsets, doesn't require Oculus Rift. That seems also to be a tacit admission that we're some way away from those 3D headsets, virtual reality headsets, reaching scale. And it is kind of true. Like, I'm coming to you over Zoom. In a sense, that is the metaverse, right? But it isn't really the vision that everybody has. And is it enough at this stage to get people accessing Facebook through its own devices? And that's what Facebook really needs. It wants to circumvent Apple, because Apple is hurting them on the advertising front. So that's the real challenge. And it does seem as though it's perhaps some way away.
Yeah, and Christine, one of the things that actually I'm seeing more and more notes on from big banks is this just a further derating? That if you look at Facebook at face value, it was not great, but it wasn't that bad. But then it also sent a snap down some 10%. If you look at, for example, Qualcomm, they saw weakness despite some very good set of numbers. So is it run for the hills?
It certainly has that feeling as far as today is concerned, Francine. And yeah, I think this really goes to the fundamental question again of what would these companies, especially these high growth tech sector companies, really have going for them in terms of fundamentals? And will that be enough to help them withstand a broader macro environment that's really turning a little bit more negative for this sector in particular? And so I think, the earnings season this time around, it really is a bit of a soul searching for investors, really digging into those individual company fundamentals and scouring through the lines of various data and trying to figure out, will these companies have enough going for them independently that they'll be able to withstand this new era of tighter monetary policy and higher yields that we're facing?
So if we boil it down to one question, Alex, is the real question we need to answer, is it too late for Meta to take on the juggernaut that is TikTok?
Absolutely not. They've got huge amounts of capital that they can invest in this, massive free cash flow. They remain highly profitable. The question is whether they allocate that capital sensibly. The struggle they have, they can't make acquisitions. Can they manage to do what they've not done previously and innovate and disrupt a company that is already significantly at scale? It's a challenge, but it's by no means impossible.
All right, thank you both for joining us. Our Bloomberg markets editor, Christine Aquino, also busy with central banks, and Alex Webb from Bloomberg Quick Take. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. President Biden says his decision to send more troops to Europe is consistent with what he discussed with Russian President Vladimir Putin. The U.S. is posting about 2,000 extra soldiers to Poland and Germany, while 1,000 based in Germany will be deployed in Romania. Russia says the move is unjustified and destructive. The UK's energy regulator is set to announce the biggest increase in household gas and electricity bills on record today. Ofgem's new price cap, the maximum that companies can charge consumers, is set to rise by about 50% from April, reflecting soaring wholesale prices that would take average energy bills to over £1,900 a year. And a new super yacht for Jeff Bezos is so large that a Dutch bridge is being dismantled so it can actually be delivered. The Amazon founder's new 417-foot ship is being built in the Netherlands and needs to pass through Rotterdam to get to the sea. One Dutch politician says dismantling the crossing is really going a bridge too far. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
And what a story, Leanne. I just can't get enough of it. You kind of, you wish you were there to actually see what was happening and what everyone was thinking at the time. Our Leanne Gerrans. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. This hour, we speak to the former Bank of England MPC member, Andrew Sentance. You can send in your questions on IB plus TV Go. Also, up next, we're live from Threadneedle Street and from Frankfurt. We have a full Divergence chat. How do traders play the BOE and the European Central Bank today? This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it is decision day in Europe's two biggest central banks, and they're taking very different tacks and views when it comes to inflation. The Bank of England expected to deliver a historic back-to-back rate hike today and to give a timeline for quantitative tightening. The ECB, meanwhile, is expected to hold rates. All eyes will be on President Christine Lagarde's briefing for clues on how she will respond to the euro area's unprecedented inflation shock. Well, Bloomberg's UK economy reporter Lizzie Burden is outside the Bank of England, and our anchor, Manus Krani, is in Frankfurt. So, Lizzie, let's start off with you, and good morning to you both. A rate rise from the Bank of England, but actually money markets are expecting quite a big hawkish stance from the Bank of England. Could they push back against it today?
Well, they certainly could, but policymakers behind me in the bank have been eerily quiet since December when we had that first hike of the pandemic. So we can only assume that they didn't want to push back on markets and economists' expectations of a rise to 0.5%. As you say, it would be the first back-to-back increase since 2004. So what, if that's baked in, economists and markets will really be interested in today is the future path of rates. And will Bloomberg Economics expects rates to end the year at 0.75%? Markets see them at 1% by June, and that's the level at which officials have said that they'll start active quantitative tightening. We'll be looking for clues in the inflation forecast and in the remarks from the governor. I know he'll be talking to you later, Francine. I'm interested to hear whether he emphasises the cost of living crisis, because that would signal that the bank's concerned about the short-term hit to consumers of hiking too steeply too soon. But if he emphasises the risk of a price-wage spiral, that would signal that maybe we can expect further tightening faster.
Thank you, Lizzie. And of course, Manus, when you look at some of the strong regional imprint that we had yesterday from the Eurozone, buttressing the euro, will that make it much more difficult for the ECB and Christine Lagarde to sound as dovish as she has in the past?
I think she needs to regrasp the narrative, push back against the pricing in the euro, push back against the pricing in the two-year yields. The message ING suggests is about patience and not panic. And when dealing with inflation, Francine, yes, the highest banner headline on record. But what's more important is to look at what's happening on the forward inflation expectations. And they are rolling over, according to Berenberg, on the 5-year basis. And therein lies her silver bullet, where she begins to redefine for the market when will the first rate hike come. If she uses the word, 2 words, makes it simple for me, very unlikely. Rate hikes this year, very unlikely. That is beginning the pushback against a market which is aggressively pricing 2 rate hikes this year, pulling them forward to July. And therein lies the problem, Francine. All central banks need to regrasp the narrative and arrest control away from the short-end interest rate traders, which are provoking the Fed and pushing the ECB and those 2-year bubbles.
I love that, Manus. Highlighter at hand. Yeah, Manus, highlighter at hand. Usually, we go through her speech to see how many times she said a word. It's one of my favorite pastimes. Thank you both for joining us, Lizzie Burden there and Manus Krani. So let's get more, of course, on the big central bank day. Moritz Kramer, Chief Economist and Head of Research, joins us. He's at LBBW. Moritz, when you look at the divergence between the Bank of England and the ECB, does it make each other's life difficult?
Good morning, Francine. Yes, I think the ECB is increasingly isolated in its stance. And I think Lagarde and Philip Lane need to come out of their bunker. And we've always heard, our decisions at the ECB will be data dependent and we will be patiently waiting for more evidence. Well, I think the evidence is there. I think that the data picture has changed quite a bit. And what we have seen since the December Governing Council meeting is sort of surprises on the upside in terms of higher inflation. We also have now sort of an unemployment rate which is below pre-pandemic levels, and we still have a monetary policy that's being calibrated against deflation fears. I mean, every single category on the price index is growing faster than the target. I really don't know what kind of data she wants to see coming in before changing tack.
So, Moritz, let's go actually to the flattening yield curve. And I imagine that will focus the minds maybe at the ECB. Lagarde so far has, of course, insisted that a rate hike is unlikely this year. Let's bring what the market is expecting. Money markets definitely skeptical. They predict a 10 basis point increase from the ECB by September. If you look at the inflation print, I mean, first of all, how did we get it so wrong? And by we, I mean everyone, almost every analyst and economist got it wrong.
Yeah, well, I think there's been the narrative. I mean, these things are driven by narratives, and we had this narrative of transition of inflation, and it's energy driven, and originally it was. But there's so much uncertainty, and if you look at the press conference in December, the word uncertainty was plastered from beginning to end all over the place. But they're behaving as if they knew for sure, and I think that's really where you're not very well position for negative surprises, as we've seen them now. What I see, speaking to clients here in Germany in particular, and I'm sitting here in Stuttgart, which is of industrial heartland. I speak to clients; they all expect a significant pickup in wage demands. They all have plans. The vast majority have plans to hike prices. So the wage price spiral, which is what central banks fear the most, is about to begin. And just ask the Fed how difficult it is to reel that in once you lost control over it at the beginning. So I think the narrative in Frankfurt needs to change. There needs to be more caution. And I think the markets are really pushing for that.
Yeah, and we see it. I mean, if you look at some of the inflation numbers, and we charted it and brought it back historically, I mean, it's really quite surprising, the pickup, the pace of pickup, and the trend that could be here to stay. So the focus for investors today is whether Christine Lagarde will turn more hawkish. But how does she do this balancing act?
Well, we'll find out. She has been pretty much stonewalling so far, but they've been dropping the transitory argument increasingly. Now the facts have changed. We are hanging this whole monetary strategy on a forecast by ECB staff for inflation next year and 2024, which is 1.8%. And if you listen to the ECB, they're saying, well, that's less than 2%. That's below the target, and that's why we need to continue to go full throttle. But we're close to the target. That means we should also be close to the steady state monetary position. And frankly, these 0.2 between the forecast and the inflation target, that's a fraction of the average forecast error that ECB staff has done over the years.
All right, Moritz, thank you so much. Moritz Kramer, the Chief Economist and Head of Research at LBBW, stays with us. We have also some great charts looking at the Bank of England and some of the market pricing around that. Also, technology always in focus after that disappointing figure from Meta. I was speaking to Richard Windsor this morning with a great note out saying maybe the market is overdoing it because, yes, they disappointed, but it wasn't also that bad. You can see it not only broadening out to some of the technology that we're used to using during the pandemic, but also infecting the broader market. Meta, pre-market, down 19%. Snap, down 15%. Even Twitter's actually being held down some 8% lower. Coming up, more on what should we expect from the Bank of England today. Inflation shocks on the continent, also in Europe. We continue our conversation with Moritz Kramer. You can send in your questions on IB plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So turbulent day for the markets. We have policy decisions from the Bank of England and the ECB coming up. We're back with Moritz Kramer. Moritz, let me bring you to my chart on the Bank of England. This is a fantastic chart, and the real question that markets really wants to ask themselves is, will they push back against the market pricing by projecting, for example, that inflation could be below 2% in the medium term? And this is what the market is expecting. So market pricing, 1% policy rate by June 22, and Bloomberg Economics does not see a 1% until the first quarter of next year. What are you expecting the Bank of England to do this year?
Well, I would concur with the market expectations here. I think if the Bank of England would have wanted to push back on the expectations that are sort of priced in, they would have had plenty of opportunities. They chose not to. I mean, we've heard from Lizzie and others on the program before that they've been very quiet, which is, well, uncharacteristically quiet. So I think they're happy to see those expectations developing, and I think they will conform with those expectations.
But, you know, there's a clear desire, I guess, to show that, you know, they care about price stability. So you're expecting a hike today, no question asked. The rest is going to be a lot more difficult, right?
No, I think there will be a hike today. I think there might even be sort of a unanimous decision on the hike. And unanimous decision, in my mind, is always a sign that you somehow missed the boat. So it's so obvious what you have to do that you know, there's not even a minority view on it anymore. So the Bank of England knows that there's more sort of price pressure built in, especially when sort of the gas prices go up in April. And they, as the Fed, are quite worried about wages going up. And we have a really hot labor market. So this is a real risk for
Moritz,
them.
thank you so much. I know. And the big question, of course, on QT. This is Bloomberg. Meta's mega miss. Facebook's parent plunges as user growth stalls for the first time ever. Nasdaq futures point to the downside. Policy split. The Bank of England is set to leave the ECB in the dust by lifting rates and signaling more to come. We're live in London and Frankfurt. And stay with Bloomberg Surveillance Early Edition. This hour we speak to the former Bank of England MPC member, Andrew Sentance. He's never dull and always on good form. Send in your questions on IB plus TV Go. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. The market's also never dull, especially on a day where the Nasdaq was really dragged lower by Facebook. This is also impacting a lot of the other markets and assets. I'm looking at commodities, they're on the way up. It seems that GDP and general output is okay. If you look at technology, a lot of companies coming out with notes saying, are we overdone with the selling? If you look at Snap, it's also down significantly in pre-market. I think Facebook, or Meta, as it's called now, down another 19%. Technology stocks in Europe also feeling the brunt, and NASDAQ futures down some 0.2%. However, away from technology and away from earnings, it's all about central banks. If you boil it down, let's make it simple so that traders can actually use some of the things that we chart on Bloomberg for you. The question is whether and how you play this divergence between the Bank of England and the ECB. The market clearly pricing in a 1% policy rate for the Bank of England by June of this year. Bloomberg Economics, however, does not see that 1% until the first quarter of next year. The main question is, will the Bank of England today push back on this aggressive market pricing? Unlikely, but also the other main question is, could they actually become as hawkish as Jay Powell was at the Fed? So the ECB must now decide how to respond to euro area inflation shock as well. That's prompted traders to ramp up bets on interest rates being lifted. This week's Governing Council meeting comes just as inflation unexpectedly surged to 5.1% in the year to January. We're now joined by Pooja Kumra, Senior European Rate Strategy at Toronto Dominion Bank. Pooja, always great to speak to you. Thank you so much for coming on. I mean, this is a terrible and difficult balancing act for Christine Lagarde after that inflation print yesterday. Can she still stick to her line, no interest rate increases in 2022?
Good morning. Yes, a very big move yesterday. Markets are pretty much spooked by the inflation prints, and we are pricing in 25 basis points in hikes by in 2022. So a meeting that was supposed to be uneventful, I think she needs to be more assertive when it comes to reinforcing the fact that ECB's current guidance, which is changed guidance on QE that will continue at least until September, and rates raising after shortly is maintained. So I think she would try to be more assertive, just given the fact that if she leaves markets clueless, they would actually start pricing in an end of QE as soon as June and a possible rate hike. So that 25 basis points in rate hikes can very quickly become 50 if Lagarde is not assertive enough. She's already told us that ECB is not following the path from Fed. We are a different country, and the growth fundamentals here are different. So I think that's what we want to see right now, how assertive she is.
Yeah, but how does she look at the, flattening German yield curve? Yesterday, certainly they flattened even more. I think we have that chart that we can show all of our viewers and also radio listeners. At what point does she actually cannot fight the market anymore?
I think most central banks try to avoid focusing much on rates per se because they don't want to target a German or a BTP yield curve. But this is the trend that we are seeing in all three curves, with G3 curves, just because markets have been so aggressive on pricing rate hikes, whether it's 5 rate hikes for Fed or BOE. That's why we are seeing this aggressive bear flattening. The moment she pushes back against any rate hikes in 2022, we would actually see more steepening, just given the fact that 2022 is a year where we are saying goodbye to PEPs, we are saying goodbye to APP. That means all QE support is ending. So that's where we could see steepening happening if we do see a pushback on rate hike front.
Okay, let's have a look at what happened overnight, right? Which is we saw swings in the euro, and I think we also have a really other great chart looking at some of the sub-zero bonds that had touched the 3-year low. Currently, okay, the Governing Council is expected to stay pat for the moment, and everything hinges on whether Christine Lagarde says very unlikely. How does she sound hawkish without completely dismissing what she said so far?
I think if they are considering 2022 hikes, they would start talking more towards more inflation upside risk. That would be our first clue that they are trying to actually push forward key decisions till March. But I doubt they will be very forceful on the inflation forecast right now, just because for now they are still have the December forecast, which see inflation below the 2% in 2023 and 2024. So I think a more firmness could come more in the March meeting. Right now, I think they will just acknowledge the fact that their risks to inflation are definitely higher. And that's not the case for Euro. It's the case for even BOE as well as Fed.
I don't know if we can look at hindsight, but actually, how could the ECB have kept a firmer handle on what market is pricing in her to do? Because now it's a bit of a communication nightmare.
Yes, definitely a communication nightmare. So far, everything was well managed because markets knew that they have an APP going on forever. They have a PEP. So now, as we are approaching the end of QE program, ECB's current guidance is very weak. And that's not giving markets any direction. So the moment QE ends, shortly after they will be hiking rates. So I think there she needs to basically give more of a time guidance. You remember Draghi did do this once. When he was ending QE program, he basically told markets that we are not hiking rates for a year's time. So this could be a possible way that Lagarde could actually push back on rate hikes. But it just seems that right now they are also uncertain. They need to actually provide us with a firmer guidance. Otherwise, Euro can really sell off from here.
Pooja, I know we can't talk about transitory anymore. This is like a banned word. But what exactly happened with that inflation print yesterday? Is it wage growth? And how did we not see it coming?
Yes, definitely. Energy prices continue to actually have an impact on the inflation numbers. But what we're also seeing is that the core inflation is picking up, which means that the wage inflation has also started to increase. I think what would be key right now is the next couple of months will be the time where there'll be more ECB will have firmer grip on how much of the wage effects that they can see in the inflation. And if that has a stronger hold, then definitely we could see rate hikes coming as soon as, I would say, possibly first quarter of 2023, just because they have committed to end the QE program. They have to end the QE program before even starting off the hiking cycle. But actually pricing something like 75 basis points of hikes by end 2023 is something that's not ECB style. They give proper guidance, they give market more notice. And I think that's what, at this stage, they will lose credibility if they do not stick to that.
Yeah, I mean, there's a number of things, including supply disruptions that maybe were minimized in the euro area. If you look at German GDP, it's really left it on the brink of a second recession since the pandemic began. Pooja, are we now seeing the whites of inflation's eyes? I love that phrase that I think we had from Trichet over the years. Is this the moment? Is it crunch time?
Well, we expect that we could see more higher numbers in the coming months before it actually starts slowing down. So we are keeping an eye on energy numbers, as well as how much, as you said, we can't use the word transitory, but I think so far it is being transitory. And even if we have China following the zero COVID policy, the impacts will be felt for longer. But I think clearly by June, if the forecasts continue to have these upsides, I think ECB will take a tougher stand. But I think before March, actually thinking that they could hike as soon as 25 basis points for December is too much right now. I think that's where Lagarde will try to push back.
Thank you so much for being with us, Pooja. Pooja Kumar, I know she'll be also with her highlighter, like I will be, to see how many times Christine Lagarde uses certain words. Senior European rate strategist at Toronto Dominion Bank, joining us today. Now, coming up, the Bank of England expected to complete the first back-to-back rate increase since 2004. And we'll be joined by the former MPC member, Andrew Sentance, who thinks the bank is getting its forecasts badly wrong. It's going to be an interesting conversation. Don't miss it. It's up next. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Bank of England could deliver a historic back-to-back rate hike today in a bid to curb inflation. The central bank is also expected to take the first steps towards unwinding some of its stimulus program. But one former MPC member is calling for a robust review of the committee's performance. Now, in an opinion piece in The Times, Andrew Sentance criticizes the central bank for getting forecasts badly wrong. He argues that diversity of debate has faded away and there is too little focus on long-term strategy. I have to say, it's a punchy opinion piece, and Andrew Sentance joins us now. Also with us is Jamie Rush, our Chief European Economist at Bloomberg Economics. First of all, gentlemen, let me also bring you to the chart of the hour, if not the chart of the week, which goes on to market price expectations of what the Bank of England can do. Now, market is pricing in a 1% policy rate hike by June of this year. Bloomberg Economics does not see that 1% until the first quarter of 2023. So at play is really whether the Bank of England today will also push back against its market expectations. Andrew, it was a punchy opinion piece. So first of all, why do you think the Bank of England is getting forecasts so wrong?
Well, I think there's a tendency in the bank just to see rises in inflation as a temporary phase. And there's obviously a lot more going on in the economy than just some of the temporary factors like higher energy prices or global supply chain shortages. But the bank has been very slow to recognize that and acknowledge that. And you'd think I think they've got a team of about 50 economists in their monetary analysis division, they would have picked up on this sooner. And so it causes me to think that there are more systematic problems with the Monetary Policy Committee that need to be fixed.
Andrew, I want to go to our chief economist in a second, but actually the Fed has also had the same issues. The ECB, I mean, they were surprised by that 5% inflation print. So is this a wider problem for central banks as a whole? I mean, what's even going on for what economists are expecting?
Well, I think the diversity of view on the Monetary Policy Committee is not what it used to be. We used to have very lively and active debates. And if you look at the votes cast on the Monetary Policy Committee, there are perhaps one or two dissenters. But there hasn't really been an active debate about alternative views of how the economy is performing. And the whole purpose of having a 9-strong committee is that you get a diversity of view and you get a proper debate about what's happening in the economy. And it seems that the MPC and its monetary advisors, as the bank economists, have settled down with a view about the way the economy operates, which is not necessarily correct.
Yeah. Do you agree with that, Jamie? It seems that, you know, the Fed will say actually the MPC is still very diverse compared to some of the conversations that are ongoing in other central banks.
Sure. I mean, I think it was a surprise to us that so many people jumped on the bandwagon to start hiking earlier this year or late last year. And whether you agree with the policy decision or not, it probably is a problem that there's. If you think that there's groupthink could be a problem at the Bank of England, then there is perhaps some evidence of that. And I have some sympathy for Andrew's view on that. On the forecasting errors, but I think, as you say, Fran, it's not something that's unique to the Bank of England. The ECB have suffered from the same problems. The Fed even more so to some extent. And actually, to get the forecast right, you have to know the internal workings of Vladimir Putin's mind, to understand what's going on with energy costs. And there's only one person.
That easy thing of mind reading
Putin. Exactly. And there's only one person who knows the answer. So I think I agree with Andrew that there are forecast errors that, on reflection, perhaps that shouldn't have been made, but a big chunk of it is unavoidable.
Yeah, Andrew, do you think, I mean, again, there will be a lot of pushback on some of the things you were saying, but is this because a lot of meetings are held on Zoom? Is it because of the pandemic and it's just much more difficult to forecast? And again, as Jamie was saying, energy prices, frankly, are just all over the place.
I think it's not just to do with energy prices. I think that's a misreading of the situation. We have many factors that are pushing up inflation, and when we look at the inflation forecast, things like skill shortages and what's happening in the labour market could be actually more important over the medium term. I think there was a misreading of really what shocks hit the economy in the pandemic. It was seen predominantly as a demand-side shock, but actually it was a supply-side shock as much as a demand-side shock, and perhaps even more so. So that's left us with an impaired capability in the supply side of the economy, which we can see through the figures on vacancies, for example. And therefore, the monetary response should have been much less accommodative, and we should have had an earlier tightening in monetary policy, perhaps starting last summer, perhaps at the latest.
I mean, certainly it was priced in towards the end of the year with the markets being really surprised. Andrew, I mean, what should we do about it? What should the bank, I mean, if they think you're right, and I'm sure there will be a lot of pushback from the Bank of England, how do you propose to deal with that?
Well, I'm suggesting that the Treasury Select Committee, which is part of the parliamentary scrutiny of the Bank of England, should take a much longer-term review about how the committee is operating now and how it's dealt with both the aftermath of the global financial crisis and the episode of the pandemic. We had a similar review, but that was 15 years ago. That was after 10 years of the MPC. We're now getting to the 25th anniversary of the MPC. And it's quite surprising we haven't taken a good look, given all the shocks that we've had in the economy, at how the committee is operating and whether it's actually doing what it says on the tin, which is to contain inflation, to be our inflation watchdog.
I mean, Jamie, if you look at the proposition of Andrew of hiking in mid-2021, I mean, that would have sent market gyrations to like a new level of crazy almost.
Well, yeah, I mean, to get inflation to target by the end of this year, you'd had to have started lifting rates in the second wave of the pandemic. So it's not obvious to me that you'd ever have been able to manage away an overshoot of inflation this year or even by the end of this year. I think, I mean, on whether the MPC needs to be reviewed, I mean, there have been reviews, they just haven't been political ones. I mean, in the sense that the monetary policy framework was reviewed by the Treasury, 2013-14, around that time. We've had the bank kind of introspective on itself under Carney's tenure. So there has been some shake-up, but I'm not, perhaps, I agree, it could be worthy of political scrutiny.
Andrew, I mean, how high do you think rates need to go, and what's the new equilibrium?
Well, I'm still in favour of a gradual rise in interest rates, but if you're going to have a gradual rise in interest rates, it has to be quite consistently followed through. So there are some people arguing for a 0.5 or 0.75% rise today. I think that would appear to be a knee-jerk reaction. But I think what the MPC should be doing today is raising by a quarter and then signalling quite clearly and then following through on that signal that they're going to gradually increase interest rates to certainly somewhere between 1 to 2% by the end of this year, and then further out into 2023, perhaps to somewhere around about 3% or so. I think there's still a hope for a gradual rise in interest rates, but if things are put off and delayed, that becomes a much more difficult thing to achieve.
Andrew, I also want to give a massive victory lap, actually, to our own Bloomberg economics team. First of all, this is market expectation going forward, and then the victory lap. Jamie, this is what we're seeing. So markets pricing in a 1% policy rate by the Bank of England by June of this year, but Bloomberg economics does not see it until the first quarter of 2023. Massive victory lap, because I think even Governor Bailey at the end of 2021 said that we were one of the only ones to get it right in not predicting a hike. Right. So why are you pushing back against market expectation, Jamie?
So my kind of general view on the UK economy is that it's not like the US. I mean, we do have labour market tightness. Andrew's right that services price inflation is picking up, and there are indications that there's a firming of pressure. But I don't think we need a Fed-style hiking cycle in order to keep those things in check. So at the moment, I mean, the bank is basically expected by markets to do what the Fed's doing. I think it'd be a much more comfortable position to be somewhere between what the ECB is likely to do and the Fed, but not all the way or at the extremes.
Oh, it's exciting. I'm really excited about actually this Bank of England decision, so we'll see what happens, and we'll have to get you both back on. Andrew Sentance, former member of the bank's Monetary Policy Committee, and Jamie Rush, our chief European economist at Bloomberg Economics. Now, coming up after that meta sell-off, we look ahead to Amazon's upcoming results. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get back to our top story and that huge sell-off in shares of Facebook's parent Meta, plus a look ahead to Amazon's results. With us to discuss all of this is our Bloomberg anchor, Danny Berger. Danny, first of all, you make everything fun, so I'm so happy to talk to you about this. I mean, it's very clear that, look, Meta reported, some results that kind of flatlined, and the market's freaking out. Is it the boomers suddenly selling their shares, saying, oh no, no one's looking at this anymore?
It does. It definitely feels like there's an element of freak out. 20% drop, that would be the biggest loss in market cap any company has ever seen in one day. Though if I were to try to justify it and do it in a wonky way, which I feel like I have to do, you could say, you're welcome, you could say, okay, these types of big tech stocks are priced for their future value. So you're in an environment where we're getting rates rising, and all of a sudden you're questioning the business model, that only random boomers in Italy are using Facebook right now. So what is their business model?
My family's guilty.
Only Francine's family is using it. So what does their business model look like? If you're reevaluating it, that's when you get this panic. That's when you get this huge drop in share prices.
Yeah, the thing is that Snap was down 10%. Then you have Qualcomm, pretty good results, but they were also significantly down. And they're investing so much on the metaverse. I mean, is this not going to pay off?
Well, if it does, it will take a while. I feel like it's just a big question mark, and for now, it's just a cost. But I do think it's interesting to see the tech giants not trade as a monolith anymore. There are now differences between businesses. Google solidifies its lead. Facebook falls behind.
Amazon, there's nothing I don't buy on Amazon. Guilty as charged.
Yes, you and me both. Look, it's going to be a tough quarter for them. They have tough comparables. There's a lot of macro influences. Shipping costs are high. Labor costs are high. So analysts aren't expecting the best of quarters, which could just add to the unpleasantness of tech today.
All right, look out for the unpleasantness. It's also, of course, selling off in Europe and broadening to that market sell-off as a whole. Bloomberg anchor Danny Berger. Fun as always, even when the news is not good. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz are in New York, and Edwards is in London. A full roundup, of course, of central banks. We have Bank of England, we have ECB. How do traders play that divergence? This is the only question you need to ask yourself today. This is Bloomberg.
Dance between the Fed and markets. I think the frothier areas of the market will continue to have headwinds.
I think that in 6 to 9 months, we're going to be having a very different conversation around inflation and demand.
If we're talking about a systematic tightening of global financial conditions, that's not as friendly an environment for equities.
Maybe I'm old school, but I think earnings do matter and will continue to matter.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
Markets feel the Facebook aftershock. The rally in global stocks falters after the social network's parent plunges more than 20% following a disappointing forecast. How quickly will central banks move to tamp down inflation? The Bank of England is expected to deliver another interest rate hike today, but guidance for 2022 is in focus at the ECB. And rising prices are likely to be the focus of a Senate confirmation hearing today. President Biden's 3 Federal Reserve nominees all say that fighting inflation is a top priority. Welcome to Bloomberg Surveillance, everybody. This is the early edition. I'm Anna Edwards in London, Matt Miller and Kailey Leinz in New York. Good morning, everybody, and good morning, Kailey. It seems that European equity markets doing their best to try and ignore that sell-off in tech, but they can't.
Yeah, and Asia really couldn't either overnight, Anna. Granted, there are still a number of markets that were closed for the Lunar New Year holiday, including China, Hong Kong, Vietnam, Taiwan. So only a few regional gauges were trading, but most of them, including Japan, were lower, taking the MSCI Asia Pacific Index down about 0.4%. There was one exception, though, and that was South Korea. The Kospi rising about 1.7%, maybe just catching up to the gains we had seen here in the U.S. over the last 3 days, catching up to that rally. It may be a different story tomorrow, depending on how this U.S. session shakes out. And you definitely saw a bid into haven assets like sovereign bonds overnight. That included Australia, where the 10-year yield came in about 5 basis points. I also wanted to point out in the commodity complex, iron ore gaining for a third day. There's a lot of optimism that policy easing in China will actually lead to some support for the industrial economy there this year. And as a result, iron ore futures were up 3.5% overnight, north of $140, Matt.
All right, we'll be watching that, and of course, we'll all be waiting for your pre-market movers today to see what Meta looks like this morning. It's really dragging on NASDAQ futures. You can see they're down now more than 2%. I think this is the focus today rather than the S&P 500, which, by the way, has had a fantastic 4 days, up from 4,300 to basically 4,600 in just a few trading sessions. The U.S. 10-year yield is down at 1.7734, so investors are buying bonds, maybe looking for some kind of safe haven there, and maybe looking for it in the Bloomberg Dollar Index as well. At 1179 right now, the dollar index gaining about 0.25%. Crude is down, but this is New York, still holding at a relatively high level, 87.33, and we're still looking at Brent crude that's up about $89 a barrel. So even with the production boost from OPEC, or the production boost pledge, because how much spare capacity do they really have left, we see oil holding strong. Anna?
Yeah, how aspirational are those pledges we're getting these days from OPEC and OPEC+. Matt, to your point about the NASDAQ being really in focus, and of course it is with those Meta earnings, how is Europe responding? Well, it looks really red, and it is, and we certainly have some weakness coming through in technology over in this part of Europe in particular. The London market holding up a little bit better, down by 0.2%. We can show you what the FTSE 100 is doing right now, and it is in negative territory. It spent much of the morning, though, actually just keeping its head above water in positive territory, but now we do see some moves to the downside. It's basic resources moving as higher, it's energy stocks moving as higher, and other earnings stories, even a catering company through the Omicron pandemic, pleasing the markets with its earnings statement today. But there is no ignoring the technology downdraft, and that's what we see here in Europe as well. The technology sector down by 2%. Even a company like Infineon, which is a chip maker, which chimes with the positive news flow we've seen from Qualcomm. They were guiding the markets higher, Infineon, just this morning. Even with that, we see that sector under pressure, that stock under pressure, as chip stocks are being taken to the downside along with those social media names. So Shell is in focus, up by 0.9%. So really bucking the trend when it comes to energy majors here in Europe. We've had a buyback pledge coming through. More detail on that, more aggressive on the buyback from Shell. And so that is something that is moving the market this morning. Roche Holdings, the pharma company over in Switzerland, down by 2.8%. A little conservative perhaps on the guidance. That's some of the messaging coming through from analysts this morning. We spoke to the CEO of Roche, Severin Schwan, a little bit earlier on today, and he was saying he gave some forecasts for how he thinks the pandemic will play out, and acknowledged there's a huge amount of uncertainty, Kailey, for a business such as Roche, such a giant of pharmaceuticals, but that has made a lot of money out of diagnostics and testing essentially around COVID-19. Where the pandemic goes, how it becomes endemic, really crucial.
All right, well, we will continue to follow the movement for some of those earnings stories. We also will follow the downdraft for technology more broadly, but there is a lot more ahead today, including some important monetary policy decisions. The Bank of England's rate decision will be at 7 a.m. New York time, followed by the ECB at 7:45 a.m. The question is, with a market that has dramatically repriced tightening expectations for both of those central banks, how do they respond today? We will also get here in the U.S. some economic data, including initial jobless claims and durable goods, setting us up for the payrolls report tomorrow. And finally, tech earnings continue. The last Titan will report Amazon due after the bell, Matt. And of course, sentiment is not great in this sector going into that print.
No, absolutely not. But of course, we did get good Google earnings, so we'll see what Amazon shows us this evening. We're going to get more on Amazon in just a moment. First off, I want to get shares of Facebook's parent Meta Platforms. They are plunging after a disappointing earnings report and outlook. This drop could potentially erase $24 billion from Mark Zuckerberg's personal fortune. Bloomberg's Danny Berger has more on the tech fallout. Danny?
Yeah, $24 billion in his personal fortune, nothing compared to what what Meta looks like it's about to wipe out. A 19.5% drop so far pre-market. Back of the envelope calculations, that's just under $180 billion wiped from market cap of Meta. That would be the biggest loss for any single company in one single day. Now, the issue really for Meta and all of these tech giants is that their pricing is very far into the future. That's how we evaluate them when it comes to valuations. So in an environment where rates are rising, if you have questions about their business model, that's when we can get these really big losses in market value. And for Meta, it's a question of, can they keep up user growth? Are the kids all just now using TikTok, so competition means they can't stay afloat? And it's bad news for the NASDAQ as well, because Meta is 5% of the NASDAQ 100. Sentiment seems to be turning. NASDAQ futures, Matt, you're pointing them out earlier today, falling about 2%. So this bounce that we saw previously in previous weeks, the concern with these Meta earnings is that that was just a dead cat bounce, and now we resume this downward draft into a bear market for big tech.
But can Amazon swoop in and save the day, Danny?
That is probably what a lot of folks are hoping for. And it is interesting to see this earnings season that tech isn't trading as a monolith. You have companies like Alphabet who can solidify their lead, Meta that seems to be falling behind. Will Amazon be falling behind? It has a lot to live up to when it comes to the cloud and really strong results from Google. Of course, it's getting caught up in this tech downdraft this morning, down 3%. But I have to say that analyst chatter around Amazon isn't exactly positive. They are an encapsulation of the macro headwinds that the entire world is facing right now. We have people less observing of those pandemic trends, maybe ordering less online, but also Amazon has cost issues, shipping, supply chain issues. That's really expensive for them. Also, we are at full employment in the U.S., so labor costs are rising, and it also means it was likely harder to fulfill a lot of the holiday shipments. So a lot of negative headlines around Amazon, but of course, Anna, that low base might mean that Amazon can surprise the upside today.
Absolutely. The twists and turns of the technology story just this week. Yeah, absolutely. High drama, high market drama, and we'll look for the read across. Thanks very much, Danny. Bloomberg's Danny Berger with the latest on the tech sector. Now, back to the central banks. It is decision day for Europe's two biggest central banks. The Bank of England is on the verge of another rate hike. Meanwhile, the ECB is set to decide how to respond to an inflation shock. Bloomberg's UK economy reporter, Lizzie Burden, joins us from outside the Bank of England, and Bloomberg's Manus Cranny joins us from outside the ECB. We felt the need to send you both into the cold to report on these stories. Lizzie, if I come to you first, a rate rise from the Bank of England today seems like a done deal. So what are we expecting today in terms of clues about the future path for tightening? A lot of talk about the cost of living here in the UK.
There is a lot of talk about it, and we're set to get an announcement later on from Ofgem, the energy regulator, on how much the price cap for energy bills is going to rise, and a statement from the Chancellor Rishi Sunak on how the government's going to respond. But I'm outside the Bank of England, and policymakers in there have been eerily quiet since December, when they hiked interest rates for the first time in the pandemic, surprising markets. And we can only assume that that silence is because they don't want to correct the assumption of markets and economists that they're going to hike rates to 0.5% today. It would be the first back-to-back increase since 2004. And if that's a done deal, what markets will be listening to is how fast and how far the bank's going to tighten across the year. So Bloomberg Economics sees interest rates ending the year at 0.75%. Markets, however, see them at 1% by June, and that's the level at which officials have said that they'll start active quantitative tightening. We'll be looking at the inflation forecast and listening to the governor, because if he emphasises the cost of living crisis and concerns about that, it could signal that the bank's worried about tightening rates too quickly and the hit that would have to consumers in the short term. But on the other hand, if he emphasises the risk of a price-wage spiral, that could signal that we're going to get further tightening fast.
OK, important. That's the stuff we need to watch out for then. And we could get further news on the passive side of quantitative tightening as soon as today, couldn't we, Lizzie? So that's the Bank of England story. Manus, let's turn to you and the ECB. A lot of pressure then on the messaging from the ECB and to what extent they can really stick to this suggestion, this belief that there won't be rate hikes in 2022.
Look, absolutely. Christine Lagarde and the ECB need to regain the narrative and the upper hand from the market, because the market is baying for 2 rate hikes by the end of the year. And indeed, we saw elevated pricing yesterday in the market up to a rate hike in July. And Christine Lagarde needs to convey patience over panic. And when it comes to the narrative around inflation, it's one of this is still deemed transitory or elevated, but not enduring. So to speak. We know Powell binned transitory pre-Christmas. The question for Christine Lagarde will be 2 words: very unlikely. In other words, a rate hike this year, very unlikely. If she really labours that point, is trying to re-grasp the narrative back from the market. Yes, she faces the strongest inflation in our lifetime here in Europe. But when you look at the forward expectations on inflation, Anna, they are rolling over. Yes, the short end of the curve has moved very aggressively, 17, 18 basis points since the FOMC just a number of days ago. So the market is pushing and putting pressure. Lagarde, well, we know that this woman wasn't for tapering in the autumn. It sounds as if she's very unlikely to be for tightening in the spring.
All right, Manus, thanks very much. Manus Cranny there standing outside the ECB in Frankfurt. And thanks to Bloomberg's Lizzie Burden as well at the Bank of England. Stay with Bloomberg for our coverage of the rate decisions and news conferences from the BOE and the ECB. It all starts at 7 a.m. in New York, 12 noon London time. Let's get over to Washington right now. President Biden's 3 nominees for the Fed appear before the Senate today. Republican members of the Senate Banking Committee have already expressed concerns over both Sarah Bloom Raskin and Lisa Cook. Senator Pat Toomey spoke with Bloomberg yesterday.
The nature of that concern is her longstanding, repeated, explicit, and recent advocacy for the financial regulators generally and the Fed in particular to allocate credit specifically away from fossil fuel burning industries.
Jack Fitzpatrick, Bloomberg government reporter, joining us now from Washington, D.C. Jack, so what do we know about the timeline and the likelihood that these nominees are confirmed?
Well, we know that they're going to come up against some Republican pushback, barring really impressive performances in today's hearings. There hasn't been a lot of pushback from key Democrats just yet, but we'll have to see how these hearings go. As you heard, one of the main points against them from the conservative members is any focus on climate change and fossil fuel and sort of slipping into more regulatory focus that has come up in Sarah Bloom Raskin's career. The other knock on one of these candidates is Lisa Cook's experience in economics. A lot of her academic experience has been more sort of on the economic history of African Americans, and there's going to be some questioning as to exactly how directly her experience ties into monetary policy. So you heard some issues from Senator Toomey. We heard from senior member of the committee, Richard Shelby, who also said he's got issues with the experience of Lisa Cook, and I think those two are going to be the knocks against them that you hear today.
All right, so that's what's going on in the legislative branch today. Let's talk about what the executive and President Biden is dealing with. Obviously, still geopolitics. Biden spoke with French President Emmanuel Macron last night about Ukraine. But the president is also focused on domestic issues, and he's heading here to New York today to promote his administration's efforts to fight gun violence. Jack, what can we expect?
Yeah, so he's going to New York. He's going to be meeting with the new mayor, Eric Adams, and they're going to talk about gun violence and the response to gun violence, obviously with the recent shootings of 2 police officers there. The president is going to play up what he's done for state and local governments, money that's gone to state and local governments, and how that ties into pushing for putting more police on the streets. Obviously, politically, it's a long way, what you're hearing from the president, from any sort of talk of defund the police that you heard from some Democrats recently. So this combination of President Biden meeting with Eric Adams at least is going to play up Democrats who want to send a message to the public that they support the police, and particularly funding for the police.
All right, Jack Fitzpatrick of Bloomberg Government in D.C. for us. Thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. Of course, we talked about the fact that Meta was plunging. It is taking other social media stocks down with it. They could face a lot of those same headwinds, including Snap, which reports after the bell today. And ahead of that, it's down 14.3%, 15.3% even before the bell. Another stock moving to the downside is Spotify. It reported yesterday subscriber expectations for the first quarter coming in well short of estimates. As a result, that stock is down the better part of 8%. And one other mover to the downside is Qualcomm. It did beat on the top and bottom line. It's still supplying a lot of phone chips. That's not the issue. The issue is if it can expand into autos, the Internet of Things. It doesn't look like it's having much success with that given some of the shortages that are out there. And as a result, that stock is down the better part of 4% before the bell, Anna.
Yeah, interesting to see Infineon in the chip space down here in Europe, despite guiding higher. When we come back, we will talk about the earnings story. Weak earnings and upcoming rate decisions weigh on the markets. Hannah Gooch-Peters joins us, Global Equity Investment Analyst at Sanlam Investments. And on the Bank of England and ECB decisions, Chris Hare, HSBC Senior Economist, joins us. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards is with us in London. We're also going to bring in Ven Ram right now, cross-asset strategist from the all-important Markets Live blog. And Ven, I wanted to start with a look at the German 2-year yields. We've seen an absolute surge, 6 or 7 sessions in a row of gains, now up to negative 47 basis points. How much does this affect the ECB and Christine Lagarde's decision? Germany obviously is a huge part, the engine, if you will, of Europe's economic growth.
Morning, Matt. Absolutely. It does put some pressure on Christine Lagarde right away. If the front end uncorks and moves higher, and it's now about the deposit rate, and that is kind of signaling that the markets are ahead or pricing in ECB tightening. Now the markets are saying go, 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 but the ECB will find itself saying no, no, no. Given that they set out their stall in December, they are unlikely to do anything just yet. If inflationary pressures continue to persist beyond the first half, they will stop their asset purchases and then review the plan as they go.
Okay, I love that summing up. The market says go, 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 and they say no. Ven, let's turn to the Bank of England. We have a high expectation that we get a rate hike there. What about quantitative tightening, though? Because they'll get their base rate to the level that they've previously said would be the point at which they'd start, passive at least, quantitative tightening. Will we hear more about that today?
Absolutely. I think that, their guidance on how they plan to accommodate that tightening is going to be very important. How are they going to run off that balance sheet? Now, as you mentioned, Anna, we are going to get the passive quantitative tightening, starting with if they move the benchmark rate to 50 basis points. But at 1%, they will start to consider active selling of gilts. Now, when is that going to come? And are they willing to bring it forward is a key question for the markets. Because if you look at the UK's yield curve, it's the flattest anywhere in the G10 world. It's like 23 basis points at the 2 points of the curve. And that is not inspiring at all from a BOE perspective. So they may want to bring it forward, their active sales, so that the yield curve kind of widens, because it doesn't serve them any good to have the yield curve this narrow.
Okay, thanks very much, Ben. Ben Rahm of the Bloomberg Markets Live team. Remember, you can get market analysis. Check out MLI Vigo on the terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Here is what you need to know. Shares of Facebook parent Meta are plunging. The social network's user growth faltered in the first quarter, the first stagnation in its history. That is stoking concerns that Facebook has plateaued after years of consistent gains. Could Amazon save the tech rally? We'll find out when the company reports after the bell. How quickly will central banks move to tamp down inflation globally? The BOE is expected to deliver another interest rate hike today. Inflation in the UK is at a 3-decade high, and it's set to rise further. Meanwhile, guidance for 2022 is in focus at the ECB as Christine Lagarde decides how to respond to an unprecedented inflation shock. And all three of President Biden's nominees to join the Federal Reserve say they place a high priority on tackling inflation. Prices in the US are rising at their fastest rate in almost 40 years. Philip Jefferson, Lisa Cook, and Sarah Bloom Raskin appear before a Senate confirmation hearing today. That's a look at what you need to know this morning. Matt, the focus undoubtedly on technology as we head towards the start of trade.
Yeah, absolutely. I mean, we are focused solidly on the NASDAQ right now, down more than 2% in the futures trade. And we've had a pretty incredible rally, in fact, on the S&P 500. On Friday, we started out the day at around 5,300, and yesterday we closed at almost, 4,300. Yesterday we closed almost 4,600. So it's been a good run, but the tech stocks drop could pull us down substantially today. The 10-year yield is coming down 176.99 as investors look to bonds for safety. Also looking at the dollar, it seems, for safety right now. The Bloomberg U.S. dollar index at 1179, almost 1180. And Bitcoin is down 1.5% from the trade at midnight and down substantially from the $38,000 and change that we saw at this time yesterday. So right now trading at 36,394. It has moved down in the last hour, and that is obviously, as we know, a negative risk indicator. Kailey, what do you see in terms of the big pre-market movers today?
They are big indeed, Matt. One stock responsible for about half those losses for us NASDAQ 100 futures you were talking about, and that is Meta Platforms, down 20%. Remember, this is a $900 billion company, so this is going to be a massive market value downdraft here. About $180 billion could be wiped from that company's valuation come the opening bell. Of course, you have Facebook user growth stalling out. Apple is creating headwinds, potentially $10 billion due to those software changes, and competition from TikTok is really just affecting the company. That has a negative read-through to other social media stocks as well, including Twitter, which is being dragged lower by about 7% before the bell today. You also had Spotify reporting last night, user and subscriber estimates for the first quarter coming in well short of what Wall Street had expected, and as a result, that stock is down nearly 9 percentage points. And of course, Anna, it all sets the tone for the last tech titan to report after the bell today. That would be Amazon. The focus here, how much have sales growth slowed down as the pandemic era has started to wane just a touch? Margin pressures, including from labor and higher shipping costs, and of course, we'll be paying attention to the cloud. Ahead of all of that, Amazon is down about 3% before the bell.
Yeah, it seems Alphabet, Google, that made us feel better. Then Facebook, Meta, that made us feel terrible. And now we wait to see what Amazon can add to the picture. In terms of feeling terrible, how terrible should we feel about the technology story here in Europe when we don't have many of those social media names to talk about, certainly not in big listed markets. But we are seeing some of that read across into the European space. So we're down by 0.7% on the stock 600. And there is no escaping that technology downdraft. The sector in Europe down by 1.9%. As I said earlier, even a company like Infineon, which is a chip company, so different from something like Facebook and Meta, but that company to the downside, despite the fact they were guiding higher in their earnings release this morning. This is something that Europe is seeing some cushioning from, and that is higher energy prices broadly speaking, through the start of the year at least, and Shell up by 1.4% in today's trading session. A big buyback being announced by this business, that reassuring to investors who are so focused, if you're involved in that sector, so focused on returns of cash. Roche Holdings in the pharmaceutical space down by 2.9%. Some conservative outlook statements coming through from the business, but a lot of focus on just how much they can really predict the year ahead. They've made so much money out of diagnostics around testing for COVID-19. The path of the pandemic from here, Matt, is going to be crucial for a company like Roche.
Yeah, absolutely. And then don't forget, we've got the car makers coming out as well. Or actually, I should rephrase that. We had General Motors with a beat, by the way, and a positive outlook. It still fell yesterday and is down 1% year to date. Tonight we get Ford. So it'll be interesting to see how the chip crisis has affected them. They're unchanged year to date, and that could turn the picture around for the industrials. Hannah Gooch-Peters, Global Equity Investment Analyst at Sanlam Investments, joins us now to talk about what we, I guess, should expect. Volatility seems not to be going away, Hannah. Even though the VIX has come down substantially, these tech stocks show us we can still really see some swings in the markets.
So we've seen some real volatility, particularly in the NASDAQ over the last couple of months. I think what has really happened is that particularly in the US, investors have become very, very focused on valuation. This is something we were warning of toward the end of last year, and I think in November it really hit a tipping point, and those chickens have almost come home to roost, if you like. There really is no margin of error for companies that are trading on very, very high price earnings multiples, very low free cash yields in terms of their earnings releases, any kind of bad news. They're now selling off very rapidly, and the market is taking a very dim view of any bad news for companies like that, particularly in the tech sector.
Yeah, Hannah, sticking with the tech sector, good morning. I put this to one of our colleagues earlier, that this reminded me of some 10 years ago when Facebook was a little slow to grasp the need to move from desktops to mobile, as amazing as that sounds now. But they did, they got there, they were just slow to start. And I wondered whether that had any parallels with the TikTok story. And then I just wonder, from a broader technology perspective, how much read across should this have? What we're talking about here, is it very specific to Meta and to Facebook? I mean, the numbers out of Google seemed better, seemed reassuring, and we wait for Amazon.
So I think in terms of market and sort of say perceptions of slowing growth, I think that companies like Amazon, for example, and also Facebook had announced this sort of 10 billion of cash being invested into the metaverse. The market is now being very cautious on news like that when we're making these big investments. And you know, any sort of slowdown, so Facebook had their slowdown in their user numbers in Q4. The market is now penalizing that. We saw things, a very similar situation with Netflix. We've seen large pullbacks in companies like PayPal. So I really think that, you know, Facebook went to a point where it was on 25 times forward earnings. And it was, in the context of this historically, it was just starting to look a little expensive. And I think that when valuations move up and you have these, you know, it might not even be that much of a big deal in the terms of a longer term outlook of a company. But I think the market is just being very punitive at the minute on companies like this.
Okay, so when you're expensive, you really have to deliver. Yes. What about the pivots into value then? This is something that's benefited the FTSE 100 since the start of the year. It's up by 2.5% when other markets have been into correction territory, for example, the NASDAQ. Is that a place that you're looking to for future gains, or do you think we get over this tech tantrum and we're back to seeking out growth?
So I think that the whole growth versus value dispersion actually happened a lot further back than investors realize. People are looking to the start of this year saying, well, you know, value is up 0.6, growth is down 7. But actually, I think if you look back, the real turning point for that was back on the pandemic day, 6th of November 2020. And if you look back to that point in time, we've actually got value outperforming growth by over 20%. And so I think this year for us, it's not so much about whether you're in the growth value bucket, whether in your value bucket. I think it's about careful stock selection. I'm actually really excited for this year because for active managers, I think it's a real point in time where you can actually be not different for the sake of being different, but this volatility that we're seeing in the market right now is really cause for opportunity for good stock selection.
Okay. And how do you factor that in regionally, Hannah? Thinking about a value rotation, where do you want to be?
Did you hear that, Hannah? Sorry, the question.
So sorry, I don't have anything in my ear.
Oh, I apologise about that. So Kailey was asking about where do you want to be in the value rotation? If you believe that value, I know you've got some doubts perhaps about it, but if you want to be in value, whereabouts in value do you want to be?
I think we have to be really careful about balance sheet strength. So a lot of the sort of value factor, if you like, is littered with companies that have perhaps very sort of low operating margins, no earnings, and are very indebted. So I think that, and particularly during the pandemic, we saw these big drawdowns. Companies that did not have that balance sheet strength and profitability were really suffered at points in time. So I think that whilst we must be mindful of valuations, we also have to be mindful of the quality of the business, in particular having, if we can, net cash on the balance sheet is very important.
Hannah, really good to speak to you. Thanks so much for coming in. Nice to see you here in the studio. Hannah Gooch-Peters, Global Equity Investment Analyst at Sanlam Investments. And don't miss Bloomberg's monthly series, Chief Future Officer. The latest episode features the Mondelez CFO, Luca Zaramella. You can also check out our interview with the Macy's CFO, Adrian Mitchell, both available on Bloomberg.com and on YouTube. Coming up, we'll be back to the central bank stories, 2 in focus today, a tale of 2 cities. Bank of England and ECB in focus. Chris Hare, HSBC Senior Economist, joins us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an exclusive interview with SEC Chair Gary Gensler. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
I think there's a tendency in the bank just to see rises in inflation as a temporary phase, and there's obviously a lot more going on in the economy than just some of the temporary factors like higher energy prices or global supply chain shortages, but the bank has been very slow to recognise that.
That was Andrew Sentance, former Bank of England MPC member, calling for a robust review of the committee's performance in an op-ed for the Times of London newspaper. Andrew Sentance criticises the central bank for getting forecasts badly wrong. Let's get more on the Bank of England and the ECB, both making their decisions today, of course. Chris Hare, Senior Economist at HSBC, joins us here in London. Chris, let me ask you what you expect then today, but also longer term in terms of rate hikes from the Bank of England, because is there a danger that with the cost of living rising in the second half of the year, depending what the Treasury decides to do about that, that the Bank of England is held back from its intention to take on inflation in the second half?
Yeah. Well, I think the prospect of a 25 basis point rate rise is pretty much baked in for today. We expect the committee to vote unanimously for that. I think what's really interesting, though, is over the medium term, the extent to which any series of rate rises will stall later on as we look forward further into this year. Now, market pricing under the Bank of England's forecast has bank rate going up to 1.25%. I think broadly speaking, the MPC might say they're kind of happy with that. Our forecast is for bank rate to go to 1% because ultimately, we do think, of course, we know that inflation's high at the moment, but we think there's still something to be said for those transitory factors. We don't think energy prices are going to keep shooting up. Supply chain disruption should dissipate eventually, and we've got that real income squeeze going on at the same time, so that should inflation come back down, should we also see some of those headwinds to the demand side of the economy, maybe that narrative of continued ever-increasing bank rate will lessen somewhat. So we think that the bank could eventually pause later.
And we'll see what the Chancellor has to say about the cost of living as he speaks later on today. Matt?
Yeah, I wonder about the strength of the pound, Chris. If you step back and look at it, obviously historically, it's been an incredibly sound currency, and it's still a financial capital of the City of London. On the other hand, you're post-Brexit, and they're very concerned about a garden party. So do you see euro-pound falling as these two central banks diverge, or what's your view on sterling?
Well, we've got sterling broadly steady in our outlook because when you think about potential divergences in policy rate, we think the bank rate will rise a little over the next few quarters, but by a little bit less than market expectations. And when we think about the outlook for the ECB, we think that the deposit rate will eventually rise next year, but will rise by a little bit less than market expectations. So that we're a little bit more dovish than the market on both, but it all sort of balances out that we think euro sterling will be broadly steady. When we think about other political type issues, well, those haven't really affected the currency in a major way over the last few weeks and months, and we don't necessarily expect that going forward.
What about growth, UK versus EU? I mean, is it still a freer market economy that's subject to faster growth?
Well, one would hope and perhaps expect that, if you observe over the last 15 years or so, that long-run productivity growth in the UK has been somewhat firmer than in the Eurozone. Potentially that UK outperformance might lessen somewhat, because if we think about it in the Eurozone, for example, we think there are potential upside risks to the potential growth outlook when we think about rising levels of public and private sector investment that we're seeing in part driven by the EU Recovery Fund, for example. In the UK, we think that, relatively sluggish post-financial crisis productivity growth can continue, but we don't necessarily see too many upsides to that. So, yes, if the UK could continue to outperform in the long run, it's still possible, but maybe to a lesser extent than we saw in the decade following the financial crisis.
Okay, Chris, so you talk about upside risks to EU growth. There clearly has been some underappreciated upside risks to EU inflation. Factoring both of those in, what message does Christine Lagarde have to send today?
Yeah, well, the inflation upside that we saw yesterday was pretty staggering. You don't see upside surprises to consensus of, 0.7 percentage points very often. And you would think that some kind of a narrative shift may have to come from the ECB, at least to some extent. I mean, already we're seeing potentially some more hawkish governing council members pushing for the ECB to more strongly acknowledge upside risk to the inflation outlook. I think Christine Lagarde probably will acknowledge those upside risks to a firmer extent than before. But will it lead to firmer policy action? I mean, what we know is that in December, the ECB already essentially sort of locked in a series of continued asset purchases through the course of this year, albeit to a decreasing degree, and that rate rises won't come until after that. Is the ECB going to change that stance? Perhaps it's not quite there yet. I think Team Transitory is still a strong voice on the Governing Council, but, I think maybe there are some risks to that policy outlook.
Team Transitory lives to fight another day. The T word is still alive and well in 2022, in a European context, perhaps. Let me ask you then about what's happening in bond markets. To Kailey's point about the shifting expectation around the ECB, we've seen certainly the short end of the curve in Europe, thinking about German bonds in particular, has been adjusting upwards, yields adjusting upwards, higher expectations that we get those rate hikes sooner. Do you think the ECB will want to blame our friends across the Atlantic for that and say this is too much to do with what's going on in the US and doesn't really reflect the European story?
Yes, to an extent, although I think given the upside surprises that we and indeed the ECB are seeing to inflation, I think it should perhaps only cautiously push back against where market pricing has got to, because there are those upside risks to inflation that in turn pose upside risks to policy rates and to bond yields. Having said that, with markets pricing in almost 30 basis points worth of deposit rate rises by the end of this year, the ECB is not there yet. So it might push back at least gently to that extent, but, only with a degree of caution given those upside risks to inflation.
Chris, great to see you. Busy day for Chris Hare, Senior Economist at HSBC. Thank you very much for joining us. And stay with Bloomberg for our coverage of the rate decisions and news conferences from the Bank of England and from the ECB. It all starts at 7 a.m. in New York, 12 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. And also joining us now, Tom Keene, co-anchor of Bloomberg Surveillance. Tom, I really expected today to be all about the central banks, the BOE and the ECB, and instead it's about tech, the Meta of yesterday and the Amazon of later.
It's about both. It's going to be a really, really interesting day. Of course, Bank of England and ECB out, and there's some real interest there. And then, of course, the Fed testimony in Washington will be sport as well. But yes, the back and forth, the good, the bad of earnings has been extraordinary, and that, of course, culminates with Amazon tonight. Let's look at the underperformance of Amazon over the last year. They're investing massively, and this is from the beginning of the pandemic with a lot of good performers. Apple outperforming, Google in yellow with a real comeback. Even Microsoft pulls up. And Amazon, just at the S&P 500 index level, has been an underperformer. A lot of people here are looking for pandemic normalization, including Joe Feldman at Telsey Advisory Group. He writes a nice summary today with a really, really enthusiastic buy on what they're doing at Amazon.
All right, so how much does this matter in terms of the volatility? Because the VIX, I think, is down at 23 or 24, and yet we're getting these wild swings in mega cap tech.
A lot of people, Matt, are saying this year it's not all boats rising. It's a story about individual securities and individual performance. To me, the earnings story of the week, and frankly, it's a tech performance, was UPS. I think UPS's performance this week was frankly more important than Google. It shows companies that execute are being rewarded in the market, and those that fail don't. And, you know, Matt, I looked at my TikTok. I mean, I'm spending more time, Matt, on TikTok than I am on Facebook. That's all there is to it.
I don't believe it. I don't believe it. You don't really, do you?
Well, it depends. I've got my TikTok coach, Samantha, in makeup, and she's got me going here. I'm watching Rihanna do foundations, and, you know, there's a lot of good lessons on here.
I would just love to see you do a TikTok dance, Tom Keene. I hope one day that is coming.
Oh, is that what they're doing on here? Those are called TikTok dances?
Yeah.
I did not know that.
So you don't actually use TikTok that much.
Oh,
Tom Keene, co-anchor of Bloomberg Surveillance. Keep on scrolling. Thank you so much for joining us. Now a quick look at what else we're watching today. I am watching what we were just talking about, Amazon earnings. Focus on margins with labor costs, shipping costs, how much has sales growth slowed down, what's going on with the cloud. But separately, I am also watching Jeff Bezos, the founder of Amazon's super yacht, Matt. They have to dismantle an entire bridge just to get it to him. Also, this thing needs a support yacht for his helicopter. I mean, that is next level money.
You got to do what you got to do. You know, sometimes you got to take down a bridge when you need to get your sailing yacht.
I guess.
Through the lock. I'm watching Ford, the big blue oval today, coming out with earnings. And interesting on a couple of levels. We're expecting to see 45 cents of non-GAAP diluted EPS, $35 billion of revenue. I'll just mention my favorite, my new favorite function on the Bloomberg, MODL model. MODL is a great way to watch earnings and financials. Ford has done incredibly well, the stock, over the last year. I put it on a chart comparing it to General Motors, Stellantis, Tesla, Daimler, BMW. It is outperforming everybody over the last year. Thank you to Dan Curtis, my producer in London, for making the Ford line blue. That is very fitting. It's just incredible, the climb, and it's now worth more than General Motors.
It is incredible. Helps you read it quickly, doesn't it, when they are all, quote, unquote, the right colour. I love the Jeff Bezos story. I'm glad you're watching that one, Kailey. I think it's just amazing timing, the battle of the billionaires, when you see one billionaire looks set. He could lose $24 billion. This is Mark Zuckerberg, if those after-hours losses were maintained through the day, of course. And another billionaire is having a bridge dismantled so he can get his super yacht out. Great juxtaposition there. I'm watching the UK energy story. We have here, in just a few minutes' time, in fact, the regulator in the UK is going to set a new price cap on energy, and this is set to be a big jump, an increase of 50% on the average energy bill. To what extent will the Chancellor then, half an hour later, mitigate that higher spending cost? This has an impact on the Bank of England perhaps as well. More surveillance is ahead. We'll hear from the Merck CEO, and Danny Blanchflower, formerly of the Bank of England, joins the team as well. This is Bloomberg.